Welcome to Dr. Fred Markets. This is not financial advice. The gap between those who understand finance and those who don't is growing every year. Markets, crypto, artificial intelligence, they just require attention. You showed up today. You're on the right side of that gap. Let's make it count. Let's go.
Real estate is quietly dying while 3D printers get rich. June home sales just tanked again even as prices hit all-time highs. Volume down, affordability dead, and yet the bubble refuses to pop because supply is frozen and boomers won't sell. At the same time, Nvidia rips another 3% while the S&P limps higher, and buried inside that rally is the real money printer. Every data center and factory racing to automate with robots and 3D printing gear that never calls in sick. And oil? Flat to down. USO is red, tanker traffic through the Strait of Hormuz is slowing, Middle East risk is spiking, and yet global markets shrug because they're betting on a future where machines do more work with less fuel. Here's the pattern nobody talks about. Your dad's path to wealth was buy house, wait 30 years. Your path is own the tools that replace houses as the main collateral of the economy, not AI models. The hardware, the printers that can spit out car parts, drones, even building chunks on demand. So let's connect this. Signal 1. Housing is unaffordable but not growing in a healthy way. Prices at record highs with volumes dropping means the market is calcifying, not expanding. When assets only trade among the already rich, they stop being engines of growth and turn into museums. You don't build a future in a museum. Signal 2. Equity markets keep rewarding productivity monsters. Nvidia, yes, but also every quiet industrial name feeding the automation beast. Sensors, chips, and the big one almost nobody retail touches. Advanced manufacturing and 3D printing ecosystems. They benefit from the same AI boom without looking like tech on the surface. Signal 3. Energy stress without panic. Hormuz shipping slowdowns and Iran-US tension should spike oil. Instead, oil bleeds and stocks hold. Markets are front-running a world where marginal growth comes from electrons driving machines, not humans driving to offices in exurbs. That makes agile manufacturing more valuable than suburban McMansions. Here's the connection. The core collateral of the 20th century was land and buildings. The core collateral of the 21st is productive machinery that can be reprogrammed overnight. A house is a passive box. A fleet of industrial 3D printers can switch from printing aerospace parts to medical equipment after one software update. That flexibility is the new location, location, location. The surprising fact, we already have 3D printed homes, bridges, and rocket parts. NASA and SpaceX use printed components for engines. High-end hospitals use printed implants tailored to your bones. This is not a sci-fi white paper. It's line items on procurement budgets. The market just hasn't emotionally priced it like it priced own a house, retire. Mechanism time. Money chases three things: yield, scalability, and collateral value.
Does what you just heard make you want to dig deeper? Good, because that curiosity is exactly what brought you here, and the second part is going to take it further. Let's go.
Real estate still offers collateral, but yield is getting choked by high prices and high rates, and scalability is trash. You can't upload a house. Industrial 3D printing and advanced manufacturing attack all three. 1. Yield. Machines run 24/7. A printer doesn't demand granite countertops. CapEx is high, but output is relentless. 2. Scalability. Software-driven. New design file, new product. That's how you break supply chain choke points without begging China or risking Hormuz. 3. Collateral. Lenders love gear that can be repossessed, resold, or redeployed. A house stuck in a dead suburb is just a monument to bad zoning. A printer can be moved to the next cheap electricity hub and keep printing margin. So what does this mean for you, sitting there drowning in Zillow listings and FOMO? Verdict. Treating your house as your main investment plan is a 1970s strategy in a 2040s economy. You still need a place to live. Just stop pretending drywall is your pension. Here's one concrete thing to do. Learn how to audit a balance sheet for real, productive assets. Look for companies where a rising share of capital expenditure goes into advanced manufacturing, 3D printing, robotics, not just more office space and buybacks. Read the notes. If management brags about flexible manufacturing cells, additive manufacturing, digital twin production, that's your tell. You don't need to YOLO into some random 3D printing penny stock feeding Reddit dreams. You map where the value chain actually pays. The industrial giants integrating printers, the materials suppliers, the software that runs the machines. The money isn't in the shiny object, it's in the plumbing behind it. Same way most fortunes in real estate were built operating boring multi-family blocks, not flipping HGTV mansions. Action plan, 3 steps. 1. Stop counting your home's value as investment. Treat it as consumption plus optional leverage, not your retirement. 2. Spend one evening this week reading annual reports from 2 boring industrials and 1 3D printing ecosystem player. Highlight every reference to additive manufacturing, on-demand production, mass customization. That's your future cash flow map. 3. Build a watch list, not a fantasy. Track how these names move when energy spikes, when shipping gets messy, when AI rallies. You'll see who actually prints wealth when the world breaks. This is not financial advice, but it is the truth. The next generation of landlords will not own more houses. They'll own the machines that build everything cheaper than your landlord ever dreamed. If you learned one new thing, subscribe. Tomorrow we dissect another lie your broker feeds you. This is not financial advice. If you enjoyed this video, please subscribe to the channel and check the links in the first comment below.
That's it for today on Dr. Fred Markets. I hope this gave you clarity and a new perspective. Remember, this is not financial advice. Always do your own research. If you found this useful, subscribe. It's free and it helps the channel grow. Find me on the blog at drfredmarkets.com and join the newsletter via the link in bio. I'm Dr. Fred Markets. See you in the next one.